All right, welcome to a quick overview of a property we closed on here recently with a client. A client closed on it. I didn't close on it. I helped him purchase this property. So everybody has a different idea of what property is right for them, and I don't think that there is a right. I met with a friend of mine. We had maybe a 2 3 hour conversation about different properties, and his thoughts went from things like, hey, should I buy an investment property where I like to vacation so that I can retire there someday and use it as an Airbnb? Should I buy storage units in this other town? Should I buy apartment complex here? What should I be investing in that's different than the market? And how would I compare apples to apples on my investments? Those questions are difficult to answer because it's really, what do you want to invest in? What kind of return do you specifically want, and can you get it where you want it? So I know that sounds like mumbo jumbo, but it's real, right? Do you want this investment? Do you want to invest in this thing for this return? And if you say, hey, I know exactly what I want for a return, um, that's great. Now we can go figure it out, right? You can say, I need an X% return. I've got Y dollars to invest. Wonderful. We can stick that into a sheet just like the one I'm going to walk through with you guys. And we can find properties that fit it. Maybe not in the location you want, right? Now we might find them, but they might be at a location you're like, oh, I didn't think about that location before. So you chew on that for a little while and we look through that location and we say, yep, now we do want that location because this is the return we want. So anyway, I'm just going to end that theoretical conversation with a friend about investing and show you guys what it looks like here. So fourplex here by Fort Collins, Colorado, 2023, July-ish, maybe it was June-ish. I don't remember the exact closing. So this was a fourplex over on Stanford, 4 units, one building, with laundry, building, all neglected. Those are my notes in the sheet. Funny thing about that is it's not actually that much neglected. It's actually in fine shape. So my notes are a little harsh. Anyway, $820,000. What do you get for 820? Well, per unit, $205,000 per unit. So some of these units are 3 beds. Some of these units are, let me see, there's 3 bed, 3 bed, 3 bed, 2 bed. So bigger units than you normally see. You normally see 2 bed, 1 bath, or kind of your traditional rentals out there at this price point. So 205 a unit. If you think about that, just kind of take that in your mind and say, where can I buy a house, a living unit, a place I can live for $205,000? And then you go, oh wait, I really can't. There aren't a whole lot of those out there. I can't buy a duplex for 410 right now. You're getting a little closer. I can't buy a single family house for 205 at all. Even a 2 bed, 1 bath single family house is going to be 450, 425 in the market. And so buying in bulk, right? So buying them together really makes the price way more affordable per unit. So that's just fun to look at. I look at this price per unit all the time. We were at a spot where we were at $90 a unit when I started looking at this. We were at $190 a unit for a couple of years in a row, and we went up to about 225 a unit. And now we're hovering here at this 210 mark, 205 mark, something like that per unit. Anyway, just a good way to look at it. Now let's take a look at this. Building one, you see I have notes from other properties I've looked at in here. I just copy it over and move on. So I've got like trailer storage, flood zone, needs rehab, 8 units, 8 units. These are different buildings. This isn't important. Don't look at this. They're just notes from other properties. This one is just the math over here. So we have 4 total units, 950, 1150, 1200, and 1250. Those are our rents. So for everybody out there in the marketplace who's renting right now, you're going, wait a second, there's a 3 bed, 1 bath place for 1150. That sounds like a dream. And it has a yard. Wow, this is great. Well, the buyer sees that too, and the buyer's like, hey, I'm gonna raise these rents back up to market at some point. They may not make it all the way to market. This specific investor might keep these rents a little bit lower than market because they value slower return and less vacancy, less turnover, right? So they'd rather have their money come back to them slower, but more consistently. If they went to market or even above market and just really tried to push their income, they may have more vacancy. So that's a decision they have to make. All right, so let's take a look here. Gross rents $54,600 a year. That's the take home, right? That's everything coming in the door. So now let's look at this like a business, right? Vacancy loss. I typically use 5%. Here I'm using 9%. It's a new property to this owner. Don't really know how it's going to work out. So I figured, let's push to 9% vacancy and subtract that money off of what he should expect to get as a return. And then just the fact of moving money from one person to another, there may be a loss or a fee or a something on it. So we're at 10% between vacancy and collection loss. So we're going to drop that $5,500 off of the top. So we're just not going to collect that. Then we have to pay our taxes. And here in Larimer County, we continue to vote for people who like to increase taxes. And so we pay more and more in taxes each year. And so there's our tax bill. There's our insurance bill, there's our HOA dues, and here's our utility payment. So those are the owner's expenses. So let's look at some other expenses. Property management. I just put in an 8% number. I know the property manager on this one is taking 8%. They have kind of a deal together between the buyer and the property manager since they're related. They negotiated that rate up front, and there it is, 8%. So they're going to pay that. He's going to pay that out of the rents every year. So now we get to repair replacement. Repair replacement, what is that? We're talking carpet, we're talking paint, we're talking appliances, light fixtures, things that wear out over time that have to be replaced on a schedule, repair, replace. So 0.5% of the value of the property getting saved every year. Is that really getting saved? I don't know, right? I'm not on the other side. I don't manage the bank account that all of this income goes to and the expenses come out of. But for budgeting, this is a recommendation, right? 0.5% of the property's value every year should go into repair and replacement. So you have a nest egg as things need to be replaced. And then the other side of that, capital reserves, I have 0.25% instead of half, I have 1/4. So $2,000 a year getting saved. Why 1/4? Well, you see this HOA fee up here at $2,820 a year. So that HOA is a master HOA that covers multiple fourplexes around this cul-de-sac. So there's a bunch of fourplexes sitting around the cul-de-sac, and this HOA manages pieces of it, not the whole thing. And so it's not like, hey, there's no exterior maintenance ever, or there's no parking lot maintenance ever, or there's no whatever ever. It's, hey, you're going to pay into this HOA, and the HOA is going to provide some level of support. And we're kind of dealing with that, just trying to figure out what does that actually mean. And so anyway, we know the HOA has some expense. We know the HOA provides some value. So I took this capital reserves, thinking capital building, right? Things that would be like when the building falls down, you'd replace it, or you'd rebuild something. You'd put in a new sewer line, those kinds of things. That'll be your capital reserves bucket that you'll use, and hopefully there would be help from the HOA's bucket of money at that point too. So anyway, normally I have these at 1% combined. So, and here we have 0.75% combined because of that HOA piece. Long rambly for $2,200 a year. Okay. So now we have debt service. Currently there's 0. This was a cash purchase. If we put in a loan, our sheet will adjust to say, hey, how much of that is going to debt service once we put an interest rate and in our term. So cash flow before taxes. So this is just the cash. How does the cash on this building work? So up here, remember we said we're gonna gross $54,600 a year. Well, now we're gonna net $24,885 a year. So less than half. So more than half of our expenses for this building are just operating expenses. So we're going to pay our taxes, we're going to pay our insurance, we're going to pay our HOA, we're going to pay our utilities, we're going to pay our property manager, and we're going to budget for losing money on vacancy, and we're going to budget for saving money on repair, replacement, and capital reserves. After we've done all that, we have a little bit less than half of our income available. So let's say, hey, there's $6,150 a year. So for our replacement reserve and capital in our account. So this money, if we actually saved it, if we were diligent and we put in $4,100 and $2,050 a year, and we said, hey, every month when the rent checks come in, we're going to put this percentage of the rent checks in this extra account over here called capital and repair. It should, at the end of every year, have $6,150 in it to meet those expenses when they come due. So our total cash return, we're really going to get in cash $31,035 every year coming in. 6,000 of that should be dropped into a savings account to take care of the property when those needs arise, unless you have a different plan. You may have a totally different plan or a better use for the $6,000, right? Like you might invest the $6,000 in CDs, or you might invest it in another property. You might invest it in an improvement to put in a laundry room that'll generate you more income and you're happy with that. Or you might save it so that when there's a problem, it's sitting there available to fix it. I have no idea how you want to run your property, but this is my sheet's estimate of how the property should be run. So let's see, what do we get for that, right? So remember, we plopped down $820,000. We got a fourplex, and we now get $24,885 of unencumbered money per year. That's kind of cool. What else do we get? So I typically leave this at 3%. I'm going to put it back at 3%. So appreciation. We don't want to bank on appreciation, right? We don't want to say it's always going to be worth more tomorrow. Most likely it's always going to be worth more tomorrow, but let's temper that, right? Because we can only realize appreciation a couple of ways. One, we can sell the property for a higher value than it is today, and now we have appreciation, but we no longer have the property. So does the appreciation serve us while we own it? Maybe not. Or we can try to borrow that money out of the property, the appreciated value, and say, hey, I bought it at 820. It's now worth $1 million. I'd like a loan of $100,000. Well, that loan's going to have a payment on it, right? So it's not just free money there either. So appreciation, we should know where our assets are, how much they're worth. But counting on that money today is probably not, it's not the most important factor. We have depreciation in here, so we're going to depreciate the property out. Let's find out why that formula didn't work. Oh, it's not in there. I deleted the formula. Okay, so we can depreciate the property out. So we're going to have our income and we're going to have our appreciation. They're about the same. So for every dollar that you make on this property, after you've paid your expenses, you're also going to get that back from the market's appreciation. And so there we are back at $50,000 of return, $49,485 for the year. So we spent we spent $820. Our return in cash is 24. Our return in appreciation is 24. We're going to depreciate it out at some point as well. Again, that depreciation won't hit us until we sell the property. So zero is not going to hurt us in our calculation. So what's our return? Our return on our investment amount is 3.3%. So this $24,000 compared to this $820,000 expense is a 3.3% return. Okay, cool. So I put my money in, I get 3.3% on it every year. Now let's look at if we add in appreciation, we're going to get a 6% return every year. Okay, pretty cool. So we invested our money. We're getting a 3% return cash, and we're getting a 3% return appreciation for a combined return of 6%. The fun thing about real estate investing to me, even on a cash purchase like this where we didn't leverage it, right? We didn't use 20% of our own money and 80% of somebody else's money and get appreciation on 100%, which is a really good strategy. This is a straight cash purchase. This property was purchased with cash, and the actual return in dollars is 3.3%. A 3% return may or may not meet your needs. I have no idea what you're looking for from your investment money. The nice thing is that 3.3% return is on an asset that most likely will never be at zero. There's almost no risk of this property value, right? This $820,000 property ever being worth $0. That's what we would insure it against, right? We would say, hey, insurance company, we don't ever want this to be zero. If it burns down, we would like it to be rebuilt. We're willing to pay for that. So that's one of our expenses right here, $4,380 for the year. Other things that would keep it from going to zero. We have a tenant that invites over a friend. The friend gets hurt. Friend finds there was negligence somewhere in the process and they sue somebody. Most likely that insurance policy is going to pay for that loss so that our property value doesn't end up at zero. We don't have to then give this fourplex to the visiting friend because of some oversight somewhere. And so the odds of it going to zero, right, would say there is no value in living in Fort Collins. There's no value here. Living here isn't worth an expense. If it's worth any expense, it's never at zero. And so that's the kind of the plus of investing in real estate over some other investment opportunities that could go to zero. I don't know a lot about those, to be frank. I avoid them. I spend my time in this world. The few times I have invested in other spaces where there was a prospect of my investment going to zero, it hasn't been. I haven't enjoyed that. It's not my comfort level. This is my comfort level, and so I'm sharing it with you guys. All right. So anyway, so at some point in the future, this property will have generated the $24,885 every year as these rents go up. Right. If we get these up to market rent, and you put in here 1,100, and you put in here 1,350, and you put in here 1,400, and you go to 1,450. What's the sheet look like? Okay, so now we're making $32,000 a year, and now we're at a 4.2% return on this 1 year, right? So you had a 3.3 or a 3.6 at 1 year plus a 4.2 at 1 year. It's not 4.2 magically. We still have to account for the lower earning years. But that's the fun of this. We can run a sheet like this out a decade. We can run it out 5 years. We can run it out 30 years. We can run it out however long you want, and say, if at this point in time I do that, what happens to my investment? And we can look at that. If at some point in the future I want to sell it, and I can sell it for 3% appreciation, 10% appreciation, whatever the number is, what does that look like? What would my return be at that point? And so that's how you can start planning your investment in sort of a sensible way. You can say, all right, with all of the known expenses, all of the known risks, and all of the possible reward, is this something I want to get into? And so we love doing this on our team. We love walking through scenarios. We like having these conversations. We like plugging in different expenses, different properties, different returns. There was a cool fourplex that had space for about 9 RVs that could park behind it. And so that was another 9 times 50. So we had $450 a month that you could generate in RV income from a parking lot that was underutilized. And so I don't know, $6,000 extra a year is pretty cool for not doing a whole lot of extra work. I mean, obviously you have to answer the phone and schedule people in and out, and all the fun. There's work, but it's not a ton of work. But it was just an underutilized part of the property that could have generated that owner extra income. And so we can plug something like that into the sheet. We can plug anything in here. I see your other trailer storage. So there you go. It's already on the sheet, ready for it. Anyway, if you have questions about how your investment property should look, if you have questions about, hey, am I managing my investment property the right way? Are we doing the right steps here? Are we charging the right rents? Are we should we have refinanced? Should we pull some money out to do something different? Ask. All we can do is walk through a sheet together, have a conversation, and hopefully you walk away with more information. If you're sitting on some investment money that you've watched get depleted, or you're worried is going to be depleted, or it's grown to a tremendous amount and you have excess, whatever your situation is, we're all in different spaces at different times. Reach out and say, hey, let's apply my money, what I have, to this market, and see, does it make any sense? All it takes is a little bit of time for us. It's a great conversation, and it opens up opportunities for you that you may love or may not love. And that's always helpful too, right? A good solid no, this is not the right path, is so helpful, right? Because then we're not wasting our time thinking about it all the time. We can move on to the spaces that are beneficial for us. So reach out. We'll walk through a sheet together. We can do it in person. We can do it over Zoom. Do it any way you want. We can investigate any options that you can think of. We can put calamity in here, and we can say, hey, here's a sewer line in year 4. Here's this in year 8. How does this work? So you can make your own informed decisions on these purchases or opportunities in the marketplace. So there's a fourplex on Stanford here in Fort Collins, Colorado, in the middle of the year 2023. I hope that was helpful, and enjoy the rest of your today.